Yeah, we tend to buy on a cash basis, and then we leverage up later. On the residential stuff, we're doing it all in cash, which is a bit, it's probably harder to get financing for that. We don't really look for it. On the office product, I think that, sponsorship like Alex and you guys, I think it's easier to get financing because you have good sponsorship. We think banks are much more, we think, ironically, even in a disintermediated market, people are focused more on relationship-driven lending, where they really want to know their counterparty, and they really want to know the asset management team and the platform that's sponsoring an asset. So from that standpoint, unless you're truly established as a global or dominant player, it's going to go more to niche-oriented groups that are perceived as serious. So I think the answer to the question specifically is we're able to get financing. It's certainly not as easy as it was, but overall I think it's relationship driven, so that speaks well for those of us that have been there for a long time.
Yeah, what we tend to do is buying assets where we can kind of push banks to their limit. So the things they trust about, happy to finance for a very competitive rate. That's usually assets we are not quite prime. There might be a little bit of vacancy, it might be a smaller town, it might be needing a bit of capex, it might be a slightly shorter lease, something relatively small being wrong with it, and for that reason the prices are a lot better and the banks are still happy to go with it. But for good secondary, there's still financing there. It drops away after that pretty quickly.
Well, for development, it's quite hard to get financing, like on what you already just mentioned, for objects which are lower than B locations, and which is one thing which is also interesting is what he mentioned is that the team which is behind the investment is interesting for the banks to know about. In former times, it was like that they didn't really care who was managing the objects, and now they get to the point where they know that it's a down to earth business, and that it's important to have somebody on the ground to look after the properties.
Yeah, actually, I have a funny anecdote on that. I met with the bank will remain nameless, but a bank that I had previously borrowed a lot from and had paid them their loans back on, so we have a very good relationship. I sat with one of the senior bankers, and he said, would you be interested in XYZ type of product? And I said, yeah, sure, it sounds good. And he says, but this time we're going to really focus on the real estate more. And I was like, okay, great. So I think that the banks are definitely a bit more in tune with the reality of what's going on now in terms of lending. Maybe it'll heat up again, but until you see a lot of volume in the sort of the secondary market of sort of how they offlay that risk, and they can get velocity turns on their capital. Right now, sort of it's the inventory turns are very low, so they're going to be much more judicious with their capital than they would be otherwise. But once that volume picks up, then they'll have less time to focus on relationships and less time to focus on the real estate. So just wait.
So that's a general, from our point of view, we're not that active on the buying side. As a REIT, you're basically by definition almost financing things at 50%. So you're an ideal partner for any bank. I think the relationship aspect is coming back and is playing a big role. I sense that the banks are, it's tough to make general comments across the whole industry, but there are some banks who've cleaned up their balance sheets who are more aggressive again. Every bank ultimately wants to grow and make money, so they're in there in the space to do business. But I sense that there are banks who will push you out. The whole issue of pushing the can down the street. Even if you break covenants or this or that, whatever, they just keep refinancing. My sense in Germany now, that's not always the case. They're getting more aggressive because they can afford to be so, to be more aggressive and actually load off clients that they don't want to deal with in the future. So the environment is changing somewhat, what it was like 3-4 years ago.
Okay. It seems to be also mainly small banks which haven't been so active before the crisis. So it's not the big names which are the most competitive. It's mostly banks you haven't heard of before.